Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We're coming to you as always from the CNBC-TV18 Motilal Oswal studios back after a weekend that's had a lot of hectic trade conversations right here in the Asian region. We'll talk about that and more. I'm Surabhi Upadhyay. As always with me is Nigel D'Souza and Rima is with us to kickstart the week. Guys, hi morning.
Hi, morning.
Hi, good morning. And it's quite the record-setting week when you look at Asia. Yeah. Nikkei has crossed 50,000 mark for the first time ever. It's up 65% from its April low. The Korean markets are soaring and they've crossed 4,000, again a record high. The question is, will this week the Nifty get back to its all-time highs?
Well, that's right, Rima. And, since you asked me last week about the one-day cricket, I think over the weekend we were celebrating that, right?
Yeah,
Don't count out champion batsmen like, Rohit Sharma as well as Virat Kohli. They came together, they took India home, consolation win, but a win nonetheless. So I'm feeling quite good on that front as well. So
emphatic win.
No worries on the cricket front. Let's get back to the markets, though. But encouraging result when India beats Australia in Australia, and by that sort of a margin. Feeling good.
Encouraging all around, actually, and it's a week, or it's been a week or a series of records for global markets everywhere. Rima talked about a couple of these Asian markets that are supercharged, turbocharged. I mean, there's some data out of China this morning. Industrial data is looking very, very robust. But even if you go back to what Wall Street was doing on Friday, well, it's records galore. The Dow managed to close above 47,000 for the first time ever. The markets were turbocharged. I mean, gains between 0.8% to 1.1% on the NASDAQ. What powered the gains? The fact that the inflation print, which actually came through on Friday after a long run, remember, we're not getting any kind of economic data out of the US at all, thanks to the government shutdown. But finally, that CPI number that came in for September, that was a shade below expectations. So it's keeping the market very, very excited about the possibility of a rate cut as soon as this week itself. So let's quickly run through the numbers and what the US CPI print actually told us. CPI is up 0.3% month on month. It's up 3% year on year, which was, as I said, slightly lower than estimates. And even core CPI was up just 0.2%. The expectation was a 0.3% rise. And that's what got the market super excited. So we saw equities move higher, not too much of a move actually in bonds. The 10-year yield has been very, very range around that 4% handle, and that did not change much on Friday. The dollar also little changed. The prospects are that the Fed will deliver a 25 basis points rate cut as soon as this week itself. If you go by the Fed watch tool, then the probability of that 25 basis points cut is as high as 98 to 99%. So that's what we're looking at with respect to the Fed. Now let's talk trade. And all of those conversations are stemming from the ASEAN meet that happened in Malaysia. So first things first, it seems that U.S. Treasury Secretary Scott Bessent, as well as the trade representative Jameson Greer, they've managed to thrash out contours of a deal between China and the U.S. And this framework should keep those 100% additional tariffs at bay that the U.S. president was threatening to levy starting November 1. And it should keep the supply of rare earth and other critical minerals and metals also going to the U.S. And in fact, Scott Bessent referred to this, saying that I think we have a very successful framework for the leaders to discuss on Thursday. Let's actually listen in to the U.S. Treasury Secretary talking about this all-important meeting. Remember, President Trump and President Xi are set to meet on Thursday this week.
This was the fifth meeting that I've had with my Chinese counterpart, the Vice Premier, Hu Lifeng, and we covered a wide range of issues, and I think we've reached a substantial framework for the two leaders who will meet in Korea next Thursday. So, on the table, the president had given me maximum leverage when he threatened 100% tariffs if the Chinese imposed their rare earth global export controls. So I think we have averted that so that the tariffs will be averted. And we have a regular quarterly meeting with the Chinese. It was scheduled for November 10th or before November 10th. I don't think we will have to have that. So we have been rolling the tariffs quarterly. So we agreed on that. We also agreed on substantial agriculture purchases for U.S. farmers. We agreed that the Chinese would begin to help us with the precursor chemicals for this terrible fentanyl epidemic that's ravaging our country. So I would say that it was a very good meeting overall.
Okay, so that's US and China, but it's not US and China. There was trade talk among a lot of nations, including Brazil. Let me move to that. Again, it stemmed from the ASEAN meeting where where Brazilian President Lula said, and I quote, that we agreed, that is, Brazil and the US have agreed that our teams will meet immediately to advance a search for solutions to tariffs and sanctions against Brazilian authorities. So Brazil has hope floating. The US signed a raft of trade agreements or frameworks with a bunch of Asian countries as well, including Malaysia, Cambodia and Thailand, capping the tariffs at 19%. Some of the tariffs will go down to zero on some products coming in from these countries. And Malaysia, for instance, has assured US that it will keep supplying rare earths. So it was all about trade talk. Now, the question for our market is, like Rima was saying, all global markets are hitting all-time highs. Will we hit all-time highs? And a lot of global economies are striking these trade agreements with the US. So will we get our trade agreement with the US or not? That really is the critical question. The Nifty managed to spend the last week in consolidation at higher levels. But the sense is that because global momentum is very, very strong, if we get a breakout above 26,100, that could really turbocharge bulls and resume the upside momentum once again. And the supports, 25,600 to 25,700, which is about the 32%, 33% retracement of the current up move, that serves as a firm support for the market. So, Nigel, let's see if the bulls can build on their advantage and get to that all-time high this week.
Well, that's right. Uncertainty on the timing and the contours of the India-US trade deal, that's what's giving the bulls a little bit of jitter, and that's why we're not able to sustain at higher levels. But the last couple of days, there are a couple of factors that are not concerning. So let's highlight that first. The FIs, from being net sellers, they actually have either turned flattish or they've turned mild buyers. So that's good news. The second point is, yes, the Nifty ended lower. But the India VIX, which is now aligning for the new series, well, that cooled off a little bit. So the VIX is not indicating any kind of panic. It appears the weaker hands gradually are getting cleared out on that front. Moving to what is not looking very, very good. Well, one is that the Nifty for the last couple of trading sessions, we have come off 150 to around 200 points from the high point of the day. So unable to be sustaining at higher levels. That's point number one. The FI short covering as well, that's the second point I want to make. We saw 50,000 short contracts come down. And the Nifty rallied more than 1,000 points. If you look at it, from this 24,600 odd mark, we went up more than 1,000 points, and the short contracts came down considerably. Now, in the last two trading sessions, the short positioning has come down by close to around 30,000 contracts, but the Nifty actually hasn't moved up. So the law of diminishing marginal utility seems to be catching up. That is, in fact, you're getting the short covering, but the markets are not moving up. So now we'll have to see some cash market buying, and also the Nifty needs to protect lower levels. So let's get straight to that itself. What is the positioning right now? Yes, the FIs are still short, but they're 75% short now from around 94% at the start of the series itself. Moving to the couple of strikes, and remember the PCR from around 1.3, it's come down to around 0.76, which is moving to the lower end of the range, which normally risk-reward turns favorable sub that 0.7 odd mark. And you have two strikes, 25,900 call, 25,750 put. So you just punch in the premiums and look at the technical levels. The near-term resistance comes in at around 25,975. Last couple of trading sessions, we're trying to get that mark, and that's got rejected. On the downside, since we saw some bit of writing at around the 25,250 put, that's the level you don't want to break on the downside for today's trading session. So that's the one we're looking at. Going to the Nifty Bank, well, that ended pat in the middle of the high and the low in Friday's trading session, ended at around 57,700 odd. You'll want it to get closer to the high and make a fresh high, because the Nifty Bank has been leading the way. It needs to resume to its winning ways. Stocks that we're looking at, there were two stocks I highlighted in Friday's trading session towards the end. Possibly it goes into the F&O ban. That's what happened. SAIL as well as Sammaan Capital. We'll keep an eye out on both these two stocks. They moved into the F&O ban. And if you look at it in an index, since the commentary coming out with regard to the US-China trade talks, there's some industrial data, there's hope of, the industry, the economy on the whole getting some kind of stimulus, the metal index will continue to remain on my radar. So I'll keep an eye out on that index as well.
That is the tailwind driving all Asian markets higher. And adding to the cheer on China today is China's industrial profits data. Data is just out. Profits have gone up by 21.6% in September. the biggest jump in nearly 2 years. And this follows an August print of more than 20% on a year-on-year basis. So data coming out of China is very strong. The Chinese index is up 1%, but across the board, Asia is up 1 to 2%. And the GIFT Nifty too is pointing to a stronger start. Dow futures too, by the way, is up close to about 250 points. Mark Matthews of Bank Julius Baer & Co. is now joining us on the show. Mark, thank you very much for joining in. You take us through the setup as you see it right now and where are we headed?
Well, one thing that you haven't talked about is the earnings season in the United States. And this is the big week where the bulk of the earnings will be coming out this week, including the big technology companies. But what we can say based on I think about 140 companies that have reported so far is the beats are exceeding both the beats last quarter and the 10-year average. So the beat rate for the companies that have reported so far is 83%, and the blended earnings for the S&P, in other words, actuals for the companies that have reported already, and then forecasts for the ones that haven't, is 9.2%. Now, when we began the reporting season, the consensus was looking for 7.8%. So I think, one good thing that you didn't managed to talk about yet, but is the earnings, and ultimately those are the most important thing for the stock market. The guidance seems to be quite optimistic too.
Does that mean the U.S. markets continue to move higher and higher? And plus, there is a potential Fed rate cut that's lined up this week. I mean, what's the outlook now from here on after this kind of a rally?
Barring black swans, and we had a potential black swan, it's still kind of lurking, which is the private debt market. And there was another bankruptcy in the auto lending space last week. Barring black swans, I don't think the auto loans are actually systemic. I suspect it has more to do with the repatriation of illegal immigrants. Then, yeah, the trajectory is that we will go higher into the end of the year. One reason for that is that this has been a retail-led rally. The institutions were skeptics, and they are looking embarrassingly underweight stocks. So I think that there will be a temptation on the part of many a fund manager to at least neutralize their positions relative to benchmarks, so they don't look like they're big pessimists in a bull market. And then I might actually point out an interesting technical setup, which is the NASDAQ 100 clearly is the big technology companies and innovative companies. Unless it declines 2.3% this week, it will have a up month, and that'll be the 7th consecutive up month in a row. Now, looking back in the history of that index, there were only 4 other times that the NASDAQ 100 had 7 consecutive up months. And if you look at what it did in the 12 months that followed those up months, there were double-digit returns in all of them, and the average was 17.5%.
All right. Hi, Mark. Good morning. Good to see you. And as always, what about these expectations of the India-US trade deal? We thought our turn was coming. It seems it's coming, but may not be as soon. How are you reading the commentary and the comments that have come through on this front? And what's your view on the Indian markets? What do you like out here?
Well, I thought that the Financial Times made an interesting observation last week when they pointed out the regions and countries that have basically agreed to Trump's terms are the ones that rely on U.S. military protection, like Japan, South Korea, and the European Union. The Chinese certainly do not rely on U.S. military protection, kind of the opposite, actually. And we have seen clearly in Chinese exports that the U.S. It matters, but not nearly as much as it used to, because globally, exports from China to the entire world are up over 8% in September to a new record amount this year in dollar terms, even though exports to the United States are down 27%. And as a percent of global imports, the United States is only 15% of global imports. So I think what we're seeing is that the exports to the United States, which would have been, of course, very important for many economies back in the 90s, back in the 2000s, even in the 2010s, are not anymore nearly as much. And therefore, I think we're seeing, in China and other places, these deals coming through. Now, the thing is that President Trump makes it up as he goes along. So, he just slapped another 10% on Canada because he didn't like what a premier of a province there did. So we don't know what he'll do with India. But I would say, broadly, the trajectory is positive. And the Indian market, as we know, has been a laggard in global terms this year. It wouldn't have been if there hadn't been this huge amount of foreign selling that we've seen so far this year, which I believe is basically just a reallocation into China. So I suppose the only bad news for India is that the better China does, the more it takes attention away from India.
Absolutely, Mark. And I was just coming to that because if we add it all up, at the end of the day, a global fund manager has many markets to go to. And it seems that the US has thrashed out a deal with the Chinese. So, the rare earth issue, at least for now, has been sorted out. In that context, do you see any reallocation towards India? Because we still don't have clarity and specifics on our trade agreement with the US. The only other thing that we can kind of call out is the fact that earnings here have been looking good. Second quarter numbers are so far so good. People do expect a better second half. So how would you look at India in the global context?
I look at it favorably because I do believe the earnings will be higher than what the consensus forecasts. The consensus was too bullish last year. And so therefore this year it's playing it safe. But I think all of the cuts in taxes and fiscal stimulus in other parts that we've seen, and of course the cuts in interest rates will translate into a higher earnings growth than is the current consensus forecast. So I'm fine with it, but I don't think it's on many people's radar screens right now. They're probably trying to catch up on China because for 5 years, basically, global fund managers just forgot about China. They didn't look at it. And then all of a sudden this year, it's come out of nowhere to surprise them. They have a lot of homework to do, a lot of catching up to do. And I think that eats up their time, gives them less time to look at other emerging markets.
Thank you very much, Mark. Always great chatting with you and throwing in the perspective about the U.S. earnings too. So far this year, the Nifty is up about 9%, while the Chinese market, Shanghai, is up close to about 20%. Let's tell our viewers what we've lined up, the interactions on the show today. So first up, coming up at 8:35, the management of Brigade Hotel Ventures will discuss their Q2 earnings. 9 o'clock, we'll be joined by the Gantharia of Green Edge Wealth Services to discuss Kotak Mahindra Bank's Q2 earnings and the RBI guidelines on capital market credit. 9:20 will be our market master for the day, Dheeraj Agarwal of Ambit Investment Managers. 9:30, the management of Coforge will talk about their Q2 earnings, and following that, Shweta Daptardar of Elara Securities will be chatting with us at 9:40 to discuss her expectation from the NBFC sector ahead of earnings. 9:50, Amit Thawani of Nomura India and Rajesh Kumar, former chairman, State Bank of India, will join in as Blackstone plans to invest nearly 6,200 crore in Federal Bank for a 10% stake. And towards the end of the show in Indianomics, Lata will speak to veteran bankers Zareen Daruwala, former MD and Standard Chartered, and Srini Varadarajan on RBI allowing banks to do acquisition finance and on the new foreign banks' interest in buying shares of Indian banks.
Time to slip in a short break. We've got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. I give you a sneak peek now, though. Dr. Reddy's, Coforge, SBI Life, eClerk Services, NCC, PTC Industries, Auto Pharma, and Laurus Laboratories. All of them will react to positive news flow, while Kotak Mahindra Bank as well as SBI Cards could see a mixed reaction. And no stock from our Top 10 will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's a Monday morning. The cues are looking up. Asia is strong. The handover from Wall Street was positive, and the Gift Nifty is suggesting a stronger open. But what about stocks? This is our research team standing by with CNBC-TV18's list of top stocks for the day. And the first up is Kotak Mahindra Bank. Gaurav, how did the numbers look?
Well, yes, when we look at the numbers, those were inline set of numbers, and let me take you through them. First, when we look at net interest income, that increased almost by 4%. Net interest margins now that have declined almost by 11% on a sequential basis, but at the same time, it was a bit lower than the street's expectation. But management says that from here on, we will see some net interest margins increasing going ahead. When it comes to PPOP, we saw around 3% growth there, and the reason being that OPEX that was flat on a year-on-year basis in this quarter. When we look at profit, now that has declined almost by 3%, but it was almost in line with what the street is expecting. Now, what remains another key positive is that the credit cost that has come down almost by 14 basis points, and now management says that from here on as well, we will see some kind of moderation in credit cost. There were a few positives in terms of deposit growth as well, because CASA that led the deposit growth. CASA deposits grew almost by 7% sequentially. When we look at advances growth, that was highest if we compare it with other peers, and at the same time, credit cost is also likely to decline. But there is another room for discussion is that when we look at the brokerage's estimates and expectations, the profitability is still a question given that bank is currently trading at a premium when it comes to valuation, and that is the reason why we may see mixed reactions, because inline set of number is what we saw from Kotak Mahindra Bank, but from here on how the bank performs is a key thing to watch out for.
Okay, all right. So Kotak Mahindra Bank is going to be on our radar. Thank you, Gaurav, very much for that. Well, we also had another biggie. Dr. Reddy's report numbers, post-market hours. Ekta, morning, how do the numbers look?
Well, they look good. The revenue was up around 9% this quarter. The margins came in better than expectations at 26.7%. The street was anticipating around 25.7%. And the profit growth was better than expectations as well. So it came in at around 1,426 odd crores. North America, as expected, declined around 13% year on year. So that was expected. But we had Europe, which did well because of the acquisition that they did for an anti-nicotine or anti-smoking therapy drug. So basically that did well. So it was up around 138% year on year. India did well. It was double-digit growth around 13%. And emerging markets performed well as well. So all of the other geographies really made up for the pressure that was expected in the US markets because of Revlimid generic going generic. Seeing more price erosion. Now, Dr. Reddy's, the big trigger is going to be semaglutide, where they will be one of the first players for semaglutide in CY26. Canada is going to be something where they could get approval in the next couple of weeks. It'll be a big trigger. They've received approval in India as well, and they will be launching in 2027 once it goes generic. So that'll probably be another big trigger to watch out for Dr. Reddy's. And if there's any kind of negativity in the numbers, it'll be cushioned by semaglutide, which is the next big thing to watch.
Okay, all right. Thanks a lot for that, Ekta. We're going back to Gaurav. Gaurav, tell us about SBI Card.
Well, yes, it was a bit of a miss when it comes to numbers, and I'll tell you why. What happened is that in second quarter, at the end of second quarter, we saw festive season kicking in, and that is the reason why when we look at SBI cards, the revolver, they declined. As a result, when we look at interest income, that has come down. Almost that remained flat on a year-on-year basis, and this was seen in the net interest margins as well, because when we look at yield on funds, that declined almost by 52 basis points on a sequential basis, and net interest margins that remained flat on a sequential basis. Apart from that, what happened is that because of the festive season, again the operating expenses, they increased because of the promotions, and as a result, when we look at operating profit, that declined almost by 10% on a sequential basis. Now, when it comes to credit cost, we are seeing a sign of relief because credit cost has come down to 9%. Remember, this is the fifth consecutive quarter where they are actually reporting credit cost at 9% or above. But at the same time, management says that from here on, credit cost is likely to remain below 9%. So that is a sign of relief. But apart from that, when we look at profit, that declined almost by 20% on a sequential basis because of all these factors. Now, going ahead, what is positive is that credit cost, which is likely to decline and sustain below 9%. Second is that net interest margins, that they are guided to remain range bound. And third is that third quarter, they believe that we will see some kind of bounce back in terms of yield. So that is something which is positive. But in terms of numbers, specifically in Q2, weak set of number, and that is the reason why we may see some kind of mixed set of reaction on SBI cards today.
Oh, okay, all right. Got that, Gaurav. Thanks very much. So mixed performance, but at least there's some relief on asset quality and credit cost. Got that. Rima, Coforge, once again, top honors in terms of growth, leading the charge for the sector?
Indeed, very strong growth. So the top line growth came in at 5.9% on a quarter-on-quarter basis. EBIT margins expanded by 80 basis points to 14%, again ahead of street estimates. And the bottom line too, aided by a forex gain, was strong. Now, in the prior quarter, there was some concerns because of the free cash flow. The company had announced a capex in the data center. Margins were a bit subdued, so the street was a bit nervous. But these numbers have allayed all the concerns. The company also, says that H2 will have robust growth. On margins, they're saying that we achieved 14%, which was a goal in Q2. Now, for the full year, we could maintain about a 14% growth. But thereafter, we don't plan to expand margins. Our focus is going to be on growth. And again, even on free cash flow, their guidance was 75 to 80%. In Q2, they managed to do better at about 85%. So, it's allayed the concerns. It's done very well. It's beaten expectation. So, the street is quite excited with this performance.
Okay. Actually, we'll be speaking with the management at 9:30 a.m. We will have the top boss at Coforge join in for more color on what's been another robust quarter. Sudhir Singh is going to join in, and he'll give us an outlook about the rest of the year on what the strategy is going to be like. Okay, with that, let's move on. SBI Life had reported numbers just as the market was closing out on Friday. Let's look at the fine print now. Yash, morning. Tell us more.
Well, good morning. So the numbers look better than what the street was anticipating on most counts, and hence I'm going with green on the stock to speak about specific numbers. The new business premium has come in line with what the street was anticipating, but a strong growth of about 27.5% on a year-on-year basis. The total AP, that has come ahead of street estimates. It's grown by about 10% in the second quarter. Retail AP growing at about 5% in the second quarter. Importantly, a very strong growth has been observed as far as value of new business is concerned, which has grown at 14%, coming in at about 1660 crore rupees, also ahead of the street estimates. VNB margins, they've been ahead of the street estimates, growing at 100 basis points in the second quarter, coming in at about 27.9% as compared to 26.9%. The stock hasn't done much. It's up about 1.5% in the last 3 months, 3% in the last 1 month. Not particularly the most expensive, but not the cheapest stock as far as the sector is concerned. With the strong numbers, the stock positioning, going with green on SBI Life.
Got it. Thanks for that, Yash. Hopping across to Vinny. She's here to tell us about e-clerks. Morning, Vinny.
Hi, good morning. So in terms of numbers that have come in for e-clerks, good set of numbers from the company. When you're looking at it in terms of revenue growth, quarter-on-quarter basis, around 7% revenue growth. Margins have seen an improvement as well of around 300 basis points. And profits have seen a growth of around 31% on a quarter-on-quarter basis. Constant currency growth, that has also seen a good improvement. 5.4% growth in terms of constant currency in Q2 FY26. Now, what is positive? Obviously, the new deal wins, that has continued to see a growth sequentially. $46 million of new deals, ACV deal wins worth is what the company has received in Q2 FY26. Overall, they managed to see a broad-based growth across industries. Where there was a bit of a miss coming in or a lag was BFSI segment as well as fashion and luxury. That segment didn't see as much as a growth as the other segments saw coming in. Apart from that, obviously, the company has also announced a buyback of around 300 crores. Tender offer price is around 4,500 rupees per share. The cash and cash equivalent on the books as on Q2 FY26 is at around 1,250 crores. Important to keep an eye out on that, but green is expected on the screen for the stock today. Good numbers.
Okay, all right, got it. Thank you very much for that, Vinny. Well, let's move on back to Ekta then for more details on Aurobindo and Laurus Labs. Ekta?
Well, interesting that they are in focus, and again because of Hetero, which is basically an unlisted pharmaceutical company, and they've received a Form 483 now for their warehouse, which is quite scathing from the US FDA. So the read-through for Aurobindo and Laurus would be positive, because if in case they do face compliance issues from the US FDA, which is likely because this is a second Form 483 that they've received for the same inspection, then that means that it could be a positive for Laurus and Aurobindo because they are in the same business. Hetero's ARV or antiretroviral business could be impacted, and that means that the likes of Aurobindo and Laurus, which basically have an overlap with Hetero, could possibly gain. Just want to point out that in terms of the observations, it's important to just put some color on it. The access to the warehousing or where they store the APIs for the US market was not made readily available for the inspection. The facility was not even disclosed to the US FDA. So the compliance issues seem to be quite serious. The windfall gain, or maybe a marginal amount of gain, could be for Aurobindo as well as for Laurus. So maybe those stocks would be in the green on account of it.
Thank you, Ekta. For that, it's over now to Vivek for NCC and PTC. Vivek, NCC seems to have won a very large order.
Well, that's right. Just to put this particular order in context, the company had given an order inflow guidance of close to 22,000 to 25,000 crore, and this particular order itself is close to 7,000 crore, 6,800 to be precise. So it's a significant chunk, and it goes a long way in actually helping the company going ahead and achieving its order inflow guidance. Let's have a look at the order itself. The company has received a letter of award from Central Coalfields, which is a subsidiary of Coal India. Now, this is for a project in Jharkhand where NCC will extract as well as transport coal to the Shivpur siding facility. Contract value is a little over 6,800 crore. Total contract period is 7 years, which includes 360 days of development period. Remember, at the end of Q1, the company's total consolidated order book stood in excess of 70,000 crore. At the end of Q1, the company had received 17% of their order book, or order inflow guidance rather, of 22,000 to 25,000. So this goes a long way. The other stock in focus is PTC Industries. The company has received a large purchase order from Gas Turbine Research Establishment, which is an arm of DRDO, which is the Defense Research and Development Organization. This particular order is for ready-to-fit single piston turbine blades and vanes. Now, the company has not quantified this order given the sensitive nature of this particular order, but they have said that the purchase order is significant and expected to have a positive impact on the company's revenue.
Okay, all right. So two companies in focus on the back of order wins. We'll keep them on the radar as well. Thank you for that, Vivek. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow around them this morning would be Dr. Reddy's, Coforge, SBI Life, eClerx Services, NCC, PTC Industries, Aurobindo Pharma and Laurus Laboratories. Kotak Mahindra Bank and SBI are likely to open on a mixed note, and no stocks really on the red side of the screen today. Okay, so that's the equity list for the morning. Let's go across to Manisha for all the headlines from the commodity markets. Manisha, good morning. I'm sure even the commodity markets are looking out for that all-important Federal Reserve meeting. What's the big headline for you?
Oh, well, absolutely. U.S. Federal Reserve meeting is one, and then you have European Central Bank, Bank of Japan. So there are three, policy meetings that are coming up in this week, and the market's clearly jittery ahead of that. But I'll start with the gainers first, and the crude oil prices, after gaining 7.5% in the previous week, have started this week on a positive note as well. Well, U.S. announcing sanctions has been one thing, but the expectation or a trade deal possibility between U.S. and China has been very, very strong, and that is what is keeping many of these industrial commodities on the higher side. So not just crude, when you look at the base metal prices, aluminum is trading in the positive. Copper prices trading near 3-month highs. The threat of 100% tariff from U.S. to China is off the table, is what we've seen or heard over the weekend, and that clearly seems to be supportive. But yes, the safe havens like gold and silver, after that very sharp decline in the previous week, have continued to decline in this week as well.
Okay, all right. Thanks a lot for that, Manisha. Well, we'll slip into a short break. On the other side, we'll get some fundamental analysis going. We have Dharmesh Kant, Head of Research at Chola Securities, who joins in. Welcome back. Hope you're having a good morning. Well, as promised, let's get in Dharmesh Kant on the show. Hi, Dharmesh. Good morning. Good to see you win. Dharmesh, you got a lot of results over the weekend. Dr. Reddy's, Kotak Mahindra Bank, and various other names. Anything stood out for you in terms of an earnings reaction that could turn into an actionable?
Yeah, good morning, Nigel. Thanks for having me on the show. The results were more or less in line with estimates across the board. Dr. Reddy's was a bit of a disappointment, particularly the North America kind of a business. But its foray more into Europe and Africa and other Asian countries may, stabilize the things going forward. So, but that we have to see. We are having a neutral rating on that. But Kotak Mahindra Bank stood out on the results front, particularly the asset quality front, which was a problem last quarter. This quarter, there seems to be out of the woods. The things have improved both on gross NPA and net NPA. Trade cost has also come down by 14 bips if you look at sequentially. At the same time, slippages were lower. Advances were quite great. I mean, 15% kind of advances goes as compared to, say, ICICI or HDFC, which has grown by 11%. NII growth was not that great, 6.5%, but that was more to do with the dip in the NIMS, which I think is the last quarter of dips, provided there is no further rate cut coming from the RBI going forward. That can again be a NIMS dilutive going forward for next 2 quarters. So net, taking the valuation to account at 2.3 times price to book 1 year forward multiple, it looks a pretty attractive bet. So Kotak Mahindra Bank looks good from a buying perspective. And ITC Hotels was another counter which looked, particularly great. Seeing the kind of, euphoria in travel and tourism across the board, we think the disposable income which is there in the hands of the people, quite a chunk of it is going to go into this side. And there, I think hotels are particularly well placed. ITC hotels being there at the same time, Taj GVK or East India hotels, one can look from the valuation perspective, which is comparatively cheap compared to their peers. So this is the sector which we think for next 2 quarters, healthy investment trading bets can be played out.
You'll want to listen in to the next conversation, Dharmesh. In a bit, we'll have the management of Brigade Hotel Ventures also joining in. But before that, I wanted to get your views on Reliance Industries, because there is a big announcement from Reliance Industries. The company has joined hands with Meta. They will be forming a joint venture which will develop enterprise AI solutions. The new entity will be called Reliance Enterprise Intelligence Limited, REIL. This was announced by Mukesh Ambani at the AGM. 70% to be held by Reliance, 30% by Meta. And initially, there will be an investment of $97 million. Now, considering that India has sort of been starved of these AI plays, and this would be an AI play. It starts off small, but there is going to be the data center, etc., cutting edge. How would you approach this news from Reliance Industries and the step that they have taken?
Yeah, good morning, Reva. It's again a positive development on the part of Reliance Industries, and they have been doing the right things across the divergent verticals. So AI is one platform where the focus has been quite high, including the data centers and all. And we believe that the discounting of the SOTP-based kind of valuation has still not happened for the AI business and the new energy vertical business, which is there with Reliance Industries. The present market cap discounts the other 4 or 5 verticals which are there in the play. And there too, we think that retail division is undervalued. I mean, 2 times the sales, whereas others in the same basket is trading at 6 times the sales. So there again, a rating is needed, and market will definitely do that. Reliance Industries happens to be a top pick in the Diwali pick from this summer to next summer. And I think it's, if you are holding it for a multi-year, 2 to 3 year kind of a play, as the discounting of AI vertical and the new energy business comes into play. So it's definitely a multi-bagger to my mind. I mean, double X from where we are. But from a 1 year perspective, we are penciling in a target of 1650 for Reliance Industries.
Okay, all right. Dharmesh, I request you to stay with us. For the time being, let's welcome our first management on the show, Brigade Hotel Ventures. That's the first management on the show. They reported a softer set of numbers in the second quarter, but the debt repayment has boosted the profitability. To discuss this and more, and what's the way ahead, we are joined by Nirupa Shankar, the Managing Director at Brigade Hotel Ventures. Hi, good morning, and good to see you in, as always, Nupur. Well, the last quarter was a little bit softish, Nirupa. But tell us, what kind of numbers should we look at, in the second half of the year? Whether it's with regard to the RevPAR, whether it's with regard to the occupancy, how do you see things shaping up, and what are the targets on that front? Nirupa, go ahead.
Yeah, good morning, everybody. Thank you for having me, Nigel. Our quarter two has actually been pretty good. Quarter two, as you know, in the hospitality sector is one of the softer quarters, but we have managed to show a 20% increase in revenue. We've managed to show a 13% increase in RevPAR, and we've also managed to show a 58% improvement in profitability. So according to us, the quarter went pretty well, and we're pretty happy with it. Obviously, the only thing is with the EBITDA margins, I would say we had a one-time additional expense. So that reduced the EBITDA margins slightly. But if that was not the case, our EBITDA margins were also on track. Same store EBITDA margins, we would have shown about 36% of EBITDA margins. So overall, the quarter went pretty well. Coming up, I think, as you already know, the second half of the year for the hospitality industry is generally the stronger year, with the wedding season kicking in, a lot of MICE and conferences taking place in the second half of the year. So we believe that especially the coming 2 quarters will be extremely strong, especially with months of November, December also looking very strong in the coming quarter.
All right. What is the target ARR though? You have that 5-star property that's going to be coming in on stream. So if you could help us out on that front, what should it look like? Directionally, where does it head to?
Typically, the ARRs that we conservatively take is around 10%. I mean, you want to take either high single digits or low double digits for an ARR growth as a conservative approach. But overall, if you look at the top line that we typically aim for with the same store hotels, if we just do a like to like, then we are looking at least mid-teens to high teens kind of a growth rate. And I think that's a very sustainable growth rate. Of course, some quarters you might do better, some quarters you might do worse. But overall, for the year, I think something in the range of mid-teens to high teens is a very acceptable and a sustainable growth projection.
So, Nirupa, hi, morning. So, just to talk about this going forward, when you say second half is going to be stronger, I mean, can you quantify that? Let's also talk about how many more rooms you'll be adding or how many more keys you'll be adding this year. What the rollout is for the next year plans, and then therefore that gets us to the question of investments and debt as well. So what are you working with in terms of debt levels this year and then rolling over into next year?
So, our current debt is extremely healthy. We just completed our IPO process, so we were able to reduce our debt level significantly. Our cost of borrowing also came down from about 8.6 to 8.2%, which is again one of the healthiest in the industry. Current debt levels are not very high. It's only about 200 odd crores, of which about 160 crores is to the parent and another 40 odd crores is an overdraft facility. In terms of debt to EBITDA, I would say the ratio is 1:1, but debt is to equity is currently 0.22. So, and this is gross debt. If you look at net debt, it's actually negative. We have more cash and cash equivalents on the book. So our net debt is actually negative, but the gross debt is around 200 crores, as I mentioned. So it's in very healthy percentages. Going forward this year, as you know, we're a development company. Hotels do take their time to develop, but we have a huge number of hotels in the pipeline. Currently, we have 9 operating hotels and we are in the process of building out 9 more. Most of these hotels will come out after the year FY 28, 29 and 30. So they're under various stages of design, development and construction as we speak. So we are building out, like I said, we're doubling up our portfolio. Today we have 9 hotels and 1,600 odd keys. The portfolio will double up in the years to come to 18 hotels and 1,700 keys. And these are hotels where we've already signed up the brand. The kind of investment we're looking at, a lot of our portfolio will undergo a bit of a change because we are moving into more of a 5-star luxury deluxe category. So the average cost per key investment that we're looking to put in, if you look at the construction cost, land, internal accruals, debt, all the pre-opening expenses, etc., it should be about 2 crores a key. Which amounts to about 3,400 to 3,600 crores overall that we would look to put into this company as in terms of investment.
And that's going up to FY 28, right? This is investment
for the next 4 to 5 years, I would say. Some hotels will start coming into the portfolio in FY 28, but the hotels will, like I said, the 9 hotels will start coming in 28, 29, 30. So I would say this investment, you can say, is going to come in over the next 5 years. I would put it that way.
Nirupa, hi, this is Reema here. I remember our last conversation around the time of the IPO, and you said that we're planning to do in the next 5 years what we did in the last 16 years. And, you're on track in terms of doubling of keys. From 1,600, you're planning to add another 1,700 keys by, in the next 4 to 5 years. Just, talking about the near term, right now, can you give us an indication of the kind of advance booking you have for the October, November, December quarter, or even for Q4 FY26? What could the potential occupancies look like, considering it's a strong quarter for you?
Currently, the occupancies our portfolio is trending around 75%. It's the way hospitality is. The advanced bookings are not a good reflection because the time to book is actually reducing. So you get a more accurate picture maybe 2 weeks in advance rather than a few months in advance. But like I said, our portfolio is trending at around 75-76%. I expect this to continue to trend in a similar way or go up by 2-3 percentage points, which is what we have sort of stated, where we are seeing the major growth coming from the ARR. In fact, our ARR growth has been about 14 to 15% for the entire portfolio. But if I just look at the Bangalore hotels, where most of our hotels are currently based, at least 40 to 50% of our hotels are based here, it's almost 20%. So there's been a push for ARR drive. Occupancy, like I said, our hotels are 75 to 76% is a pretty healthy occupancy rate for the entire portfolio. So while it may go up by a few percentage points, but our focus is on actually on the ARR, which is where we're seeing more of the growth.
Okay, we'll leave the conversation here. Nirupa, thank you very much for joining in. So the key metric to track for Brigade Hotel Ventures will be the ARR growth, the average room rent. In Q2, 14%, but in some of the key properties in Bangalore, it's at 20%. And as the company moves towards a more premium offering in terms of hotels which are in the pipeline also, the company expects the ARR to remain very strong. Get into a break then. On the other side, Sudarshan Sukhani and Mitesh Thakkar will join in with some technical trading ideas. Stay tuned. Welcome back. As we prepare for opening, let's go across to Hormis now, who joins in with a list of companies you should have on your radar where the shareholder lock-in ends today. Hormis.
Morning, Rima. And 10 companies whose shareholder lock-in ends today. Interestingly, 6 of them are trading below their IPO price. And shares worth almost 17,000 crore rupees free up for trade. And a lion's share of that comes from Vari Energies. That around about 16,000 crores comes from that itself. Of course, we need to mention that the lock-in period ending does not mean that all of those shares will be sold in the open market. They just become eligible to be traded. You take a look at this list briefly. You look at Atlanta Electricals, around shares worth around 150 crores free up for trade. The stock has done well since its listing. 1 month lock-in ending today, 40% higher than its IPO price. Seshasai Technologies, the stock saw healthy subscription in its IPO, but the stock is still down around 10% from its IPO price. That will see shares worth around 112 crore that will be freeing up for trade today. GNG Electronics has done well again from its IPO, 37% higher from issue price. That shares worth around about 100 crores free up for trade today. The 3 month lock-in period ending. IndiCube stock around about its IPO price, but still below it, around 150 crore worth of shares, 3% of its outstanding. And here too, there is a 3 month lock-in period ending today. Jaro Institute was another IPO that was in the news, down about 25% from its issue price. Shares worth around 54 crore free up for trade today. Solar World, another one, 12% below from its issue price, 4% outstanding frees up today. There's a 1 month lock-in ending. Anand Rathi, that has done well from its IPO. It's up around 23-24% from its issue price. The 1 month lock-in ending today, 54 crore worth of shares here as well. In this, 138 crore shares worth of shares and freeing up here. Ganesh Consumer is one of them. Another 5% outstanding freeing up for trade today. Brigade Hotels, that's a 3 month lock-in ending. Almost 2 crore shares free up for trade today. 5% of the outstanding. The stock is still below its issue price of 90 rupees. And of course, the lion's share coming from Vari Energies. That's a 1.5 year and beyond lock-in ending today. 4.5 crore shares will free up for trading. Almost 16% of the outstanding, and that is 15,840 crores. And that's the only one among the list that has more than doubled from its IPO price. Of course, that's a long trading history, but still has done well, has Vari Energies.
Okay, all right. Thanks a lot for that, Hormus. Well, let's turn our attention to select counters that are going to be in focus this week on account of court hearings. The likes of Vodafone Idea, Vedanta, and IEX. So Darshan's compiled the neat list with, and he's joining us to tell us what to track. Hey, sir.
Good morning, Nigel. So it's a big week not only for earnings but also for 3 important cases. First one is Vodafone, it's related to AGR. Second one is Vedanta, it's related to demerger. And third one is IEX, which is related to market coupling. And all these 3 cases would be heard in different courts. So first talking about Vodafone, Idea AGR case. It would be heard by CJI-led bench, and the case is going to be heard today. Remember, it's been more than a month. First time Vodafone Idea's revised plea was heard on September 19. Good part in this case is This time, both Supreme Court as well as Centre want the resolution to this case ASAP, or say at the earliest. In the last hearing also, Supreme Court wanted Centre to just take a decision or take a stand and let the court know what exactly that stand is. So the expectation would be that Centre in today's hearing comes out with its stand on the AGR case related to Vodafone Idea. Second case is Vodafone demerger. It would be heard on October 29 and it would be heard at NCLT. Now, the last time in September when the case was heard at NCLT, and the reason it was deferred because certain objections were raised by Oil Ministry, or say Ministry for Petroleum and Natural Gas. So the expectation is also at this place also that finally NCLT will come out with its verdict. Last one is market coupling case. Since the CRC order was announced and that was against IEX and was in favor of other power exchanges. So in August, IEX had approached Appellate Tribunal, that is Electricity Appellate Tribunal, and on October 13, the last order had come in which IEX was asked to file the revised plea and also have more parties like Power Exchange, Grid Corporation of India and others. So IEX was asked to file the revised plea in a week from October 13, and all the other parties were asked to file the reply to the plea filed by IEX before October 30th. So that also would be important. And remember, all these three stocks have seen a big uptick in the last few sessions.
Oh, yes, absolutely they have. And this is great context, very helpful to revise our memory. So thank you so much for that. So 3 important court cases impacting those companies and perhaps those stock prices as well in focus this week. Dharmesh, before we let you go, I just wanted to get your call on Coforge and really what lies ahead for the stock. I don't think the numbers leave any room for complaint. Growth remains very, very robust. The stock has also been fairly ranged. I mean, it's cooled off this year so far. It's down some 7-8%. So, is this a great entry point for Coforge, or do you think that perhaps, the kind of bull run that we've seen on the stock, that's kind of behind us now?
Yeah, good morning, Surabhi. Absolutely no point of complaint as far as Coforge numbers are concerned. Excellent set of numbers on all parameters, even though there was a good margin expansion. And the geographies have been doing well, particularly the North America part. And if you look at the IT companies, be it Persistent, Coforge, Signity, these are the companies which are into services support system, be it implementation or system integration and application integration or various softwares into play. And these companies are doing well as compared to the product IT companies. So we do believe that this continuity is likely to go forward, whether the product is AI enabled, ML enabled, or a simple product, all will lead implementation and services to support for the ongoing execution. And there, I think these companies will continue to find traction in the business traction. Valuations are a bit expensive if you look at on a PE multiple terms and compare it with the margins of the bigger ones. But I think the margins are catching up with double digit at mid-20s kind of a margin next 3 to 4 years can likely be there. So one last leg of rally, I think, is still due from a short-term period. So we have been recommending Persistent and Coforge as our portfolio buys, and Signity now adds to the list. So these 3 companies look pretty exciting to us.
Okay, all right, got that. Dharmesh, we'll leave it on that note for today. Thank you very much for joining in. You have a good day. We'll take a quick break. On the other side, we'll have the pre-opening rates, so almost 9 o'clock. We'll also be in conversation with Digant Haria of Green Edge Wealth Services. We'll talk about a slew of these bank earnings that have come through. A whole lot of bank deals have come through. And remember, we had important RBI guidelines that limit the capital market exposure that banks can take. We'll discuss all of this and more in just a bit. Welcome back. Just a minute to go before we start getting in our pre-open rates, and a whole raft of stocks are going to be reacting to their numbers, the likes of Kotak Mahindra Bank, SBI Card, Dr. Reddy's, and so many others. Okay, we've got the first rates in on the Nifty, 0.5% up. Let's see. 25,910, 11. Remember, the market was getting a little tired around 26,100 thereabouts. Those were the highs that we had touched last week. And from there was a bit of a cool-off. So let's see if this week is going to be the all-time high week. We've got our technical experts, so let's straight away get to them. Sudarshan Sukhani as well as Mitesh Thakkar. Gentlemen, good morning and happy Monday to both of you. So that's the question, right? Mitesh, you go first. Is it going to be the all-time high week or not? And I mean, you were rightly cautious and you had advised profit taking at higher levels last week. What is your strategy for Monday?
Good morning, Surabhi. Yeah, last week, what happened was that we had a good rally starting from 24,590, and during Thursday last week, we had rallied by about 1,600 plus points, and we were near the previous highs. There was also a gap which was there, and we were overbought on the intraday hourly to hourly chart. So I think a profit was a good objective. I think that was very a high probability event, which has played out. Now, on the downside, I was looking at possibility of 25,800, which was tested and held. I think we got a closing just around that level. And then, in the worst case scenario, 25,600. So the directional bias is still on the upside. I think we will at least, if not get past, attempt the earlier highs again. So on the upside, I think, the first target would remain around 26,150 to about 26,250. And till you break or close below 25,600, I would clearly maintain a positive stance.
Okay, fair enough. By the way, the market's now turning a little wobbly. It's a volatile start to the pre-open session. Nifty is lower by about 25 to 30 points at this juncture. So let's see how it settles this session. Sudarshan's also with us. Good morning, Sudarshan. How are you approaching trade?
Yeah, good morning. Well, if I remember correctly, on Thursday morning when we had that gap up, I had said this gap up will not sustain, get out now. And that was a good call because from that point, we fell almost 400 points. This is a rally which we are likely to see today after a brief correction. This is always a good place to be in. So I would say, look to buy this market. We had an uptrend, we had a sharp correction. The chances are the uptrend would resume, but there's no rush. Don't buy a large gap up. Wait patiently for markets to stabilize. Keep a stop at 25,800 and stay or go long whatever levels you have below the opening price.
Morning, gentlemen. Happy Monday to both of you. So what about stocks, Sudarshan? What do you have on your radar?
Well, it's an all-buy list. Vedant is a buy with a stop under 485. MGIL is a buy with a stop under 1280. 1280. PI Industries is a buy with a stop under 3510. And finally, Siemens is a buy with a stop under 3100. This market is in an uptrend. There's a party going on in all over East Asia. We are not part of that, but still we should see small up moves anywhere.
Okay. And Mitesh, let's come to your stock list as well.
Yeah. I have a mix of buys and sells more towards the buy side. So the first stock is Overall Reality, which I would recommend buying the stop at 1670 for targets of 1765. Then a buy on Asian Paints with a stop at 2479 and a target of around 2550. Conditional buy on Indus Tower. See, the chart setup is good, but there's a historical pivot at around levels of 363. So let it cross that. 364 should be a trigger to buy. Above that, buy with a stop below 358 for a target of 378. And one sell call, that's Supreme Industries. Keep a stop at 4070. Look for targets of around 3850.
Thank you. 3 reasons to watch Indus Stars. 1, on the technical front, as Mitesh pointed out. But 2, results today. And 3rd, the Supreme Court hearing the Vodafone Idea AGR case. So there are implications for Indus Stars too. But let's talk about the banking space because RBI has announced draft rules for allowing banks to finance acquisitions. Ritu joins in with the details.
Well, yes, RBI has finally put out these draft rules on capital markets and acquisition financing for banks, setting some clear limits and safeguards for this kind of lending by banks. Now, a bank's total capital or total exposure to capital markets, both direct and indirect, for instance, is going to be capped at 40% of the Tier 1 capital. Within that, the direct exposure, which includes investments plus acquisition finance, cannot exceed 20%, and specifically acquisition finance alone is capped at 10% of the Tier 1 capital. Now, on acquisition financing, much awaited 4th first time, RBI allowing banks to lend to Indian companies that want to buy stakes in other companies, whether in India or abroad. But RBI says these deals must be strategic, aimed at long-term growth and not short-term profits. The bank's total exposure to these acquisitions cannot exceed 10% of Tier 1. But to qualify as well, these acquiring companies have to be listed, have a positive net worth and must have been profitable for the last 3 years. Banks can also only fund up to 70% of the deal value, and the rest has to come from the company's own equity. And also after the acquisition, the debt to equity ratio, RBI strictly says, cannot be more than 3:1, and the loan must be fully backed by shares of the target company as security. Next, let's also quickly talk about the capital market intermediaries, where banks can lend to them only if the loan is fully secured and the collateral actually belongs to the borrower. They also can't finance them for proprietary trading or investment of their own. When it comes to IPO, FPO and ESOP financing, banks can lend up to 25 lakh rupees per person, but covering only 75% of the subscription value. And finally, loans against securities for individuals, banks can lend up to 1 crore. Within that, 25 lakh rupees can be used for buying shares in the secondary market. Now, overall, bankers we've been speaking to have welcomed the move, but not all their requests have been addressed. They are going to seek certain clarifications. For example, whether banks can also finance foreign companies that are looking to buy in India, not just Indian companies making acquisitions. Also, there's been some concerns about the clause on acquiring company being a listed entity, the profitability and the 3:1 debt to equity cap after acquisition, because, especially for deals involving distressed assets, this could be this particular thing could be a concern. Public comments are invited by the 21st of November, and final rules will kick in from the next fiscal year.
Okay, Ritu, thanks very much for that. That's a great framework to have and to keep in mind. Lots and lots of norms coming in on both acquisition financing as well as the capital market exposure. Now, is this really going to help boost growth? That's the literal question that we have. Digant Haria is with us. Digant, let's start right there. So there is an enabling framework. The RBI seems to be getting a little more liberal when it comes to capital market exposure, but still the aggregate, like Ritu explained, still capped at 40%. On acquisition financing, now, given the current caveats, the net worth criteria, the listed entity criteria, will this really take off? Or are there too many checks and balances to make a material, impact when it actually comes to, credit offtake on the wholesale side or on the corporate side?
Morning, Zurbi. See, I think it's a good start. RBI, if you look at the history last 20-25 years, RBI has been very allergic to allowing banks to finance two sectors. One has always been real estate, and second, it has been the, this entire capital market linked, whether it is for shares, whether it is for M&A, or, whether it is share swaps or things like that. So I think what we are seeing now is a good start. And in a way, it is also an acknowledgement by RBI that a lot of growth in the future is going to come via the acquisition route. We see that a lot of large sectors in India have slowed down. So I think acquisitions will be the next leg of growth for the next 5-10 years. And, rightly so, RBI has started. See, there is always more to desire, right? The first draft can never be perfect, but I would just say it's a good start. Till now, the last 10 years, we had this route called structured financing, where guys like JM Financial or, Edelweiss or Yes Bank of the past used to do those deals. Some of those deals will come in the banking domain, but I think a lot of deals will still remain in that structured finance domain where banks are not very, very active. So I think it's a good start, and we'll pick it up from here. I think, RBI also keeps on tweaking guidelines, but the intent of RBI is very clear that we want to allow growth via all different things.
So Digant, you don't see any implications for NBFCs or the private credit market. That will continue to thrive. You don't see banks taking away market share from them to finance this. And have you spoken to anyone in the industry? What could be the response? These are draft guidelines. It's open for feedback. What has been the feedback from the community?
Yeah, on morning, Rima. See, the banking sector over last 8-10 years, they've completely shied away from this kind of financing, right? Because we saw what happened in the last 10 years. So I think banks will take time to build those expertise, to understand the product, take some risks. So I think it's a slow journey for banks. Most of them are not even very keen to do corporate finance. Like if you just look at corporate lending, except for the PSUs, the privates, they don't really have, are very gung-ho on even corporate lending. M&A financing and, these capital market related financing, that comes a stage later. So I think it takes a lot of time. I don't think it will push growth immediately for any of these banks. The private credit market, the structured finance market will continue to do well. And, guys like JM Financial who have been doing these for, ages, I think they benefit more because now they can even partner with banks for their funding. They don't just need to partner with the private equities or the sovereigns or, the institutions.
Okay, all right. Hi, Digant. Good morning. Good to hear your thoughts as always. A quick word, Digant, on the banking numbers that came over the weekend, namely Kotak Mahindra Bank. Numbers look pretty okay. Some argue that valuation-wise, it's a little expensive, but that's always been the case. So your take?
Yeah, morning, Nigel. See, there were 15 or 16 banks which reported results over, last 3 or 4 working days, sparing the Diwali holidays. I think one theme, Nigel, is that margin compression, we were expecting anywhere between 15 to 18 bips at a sector level, but that has only come to like 7 or 8 bips. So I think the whole sector that way has done much better than what had been our anticipation. Coming to Kotak specifically, I think they had a slightly higher margin compression than, say, an ICICI or even an Axis Bank. Maybe because they were very heavy on, microfinance, personal loans, all these new products which they did in the last 2-3 years. So I think now we are at the bottom even for Kotak. Nothing to, read negative in the results. But yeah, it's just that, the good results is probably December or March is when we really enjoy the results as well. But nothing negative, Nigel.
Okay, nothing negative. Digant, unfortunately, we're out of time because we're running into market open, but we look forward to a longer conversation on some of these aspects. There are earnings, there's the regulatory change, and then there are deals galore in the BFSI space, right? So look forward to talking to you again in more detail. By the way, we continue talking banks and financial services even at 9:40. That is the fulcrum of our discussion. We'll be having an investment banking head who's actually participated in some of the deals. I'm talking about Amit Thawani of Nomura India. And of course, a veteran who knows it all, Mr. Rajneesh Kumar, former chairman of SBI. Spate of deals, regulatory relaxation. Is it a new approach from the RBI that's triggering so much of interest by private equity as well as foreign financial institutions? We discussed that at 9:50. But for the time being, we have a market to deal with. So let's quickly get back to our technical experts for some final trading cues. Sudarshan, which stock will you go with?
I'll go with Siemens, buy with a stop under 3,100.
Okay, and Mitesh, your stock?
I'll go with the buy call as well, a buy on Asian Paints for targets of 25.50.
Okay, all right, gentlemen. Thanks a lot for that. Well, I'm focusing on the steel stocks because InCred has come out with a note on steel and they're sounding more optimistic after a while. Let's take it piece by piece. On Tata Steel, they've upgraded to add from a reduce. The target price is around 224 rupees per share. They're saying that it's a leverage play on India's industrial upcycle as well as Europe's post-war reconstruction boom. Now, they go on to mention that the Russia-Ukraine conflict, it's nearing an end. And Europe is ready to rebuild, the entire economy out there. And that could be estimated at a big, big number. More than $80 billion or thereabouts is what they're talking about in terms of fresh demand. And that will be a tailwind for steel. Back home, policy protectionism as well as strong domestic growth, that's what's anchoring visibility all the way till 2030 odd. On Tata Steel, they're saying that yes, the captive mine auction may lift costs, but India's self-reliance push, that's what could hold the margin line as well. So on Tata Steel, upgrade coming in there. Similar is the case with SAIL. They have upgraded the stock to add. The target price has almost doubled, 158 rupees now. They're saying that the company is a tactical play on the protectionist stability and not just a cyclical swing. They also go on to mention that the fully integration with regard to iron ore, that's a key benefit and key advantage for the company. They go on to state that, in fact, on the operating leverage, that's driving recovery, volumes rise, finished steel mix as well will get strengthened, and staff costs could inch up only marginally, which has been a problem otherwise. So that's why they're positive on SAIL. And on JSW Steel, they retain the reduced rating, but the target price they've upped from around 770 rupees earlier to around 939 rupees. They say the street loves its flawless execution, but valuations test gravity, as the stock is trading at 4 times price to book value. And they're also talking about the consensus is talking about EBITDA of around 34,000 crores for the year. But at the half-year mark, it's only at around 14,000 crores. So they're retaining their reduce, but they've upped the target price. So steel stocks in focus for today.
Okay, all right. So we'll watch out for the ferrous names. And we're all set for an opening, which will be almost 50 points higher on the Nifty. 25,830, 840. This is the vicinity around which we have opened up. Let's straight away look at Kotak Mahindra Bank. Kotak is down 2.5%. So some are saying that, perhaps the margin issue is still playing out. Remember, some of the other banks like ICICI did a lot better on the margin front, where the compression was not as much as what was feared. But for Kotak, they have taken that over 10, I think it's 11 basis points hit on the margin. So maybe it's just that 2% lower for the time being. Let's see if we can pull up SBI Card before we get to the rest of the Nifty. SBI Card is down 3.5% right now, 3.5%. Because remember, like Gaurav was explaining, while asset quality is improved, credit cost is improved, their revolver rate is still leaving a lot to be desired. The net interest income has not risen as much as what the street would have wanted. So that's a stock that's under pressure. Anyway, the Nifty is charging ahead. So let's focus on the good. 70 points higher. SBI Life is a stock that's running away. Good numbers coming in. That's one that's reacting well. And the ferrous names like Tata Steel that Nigel was just talking about, 1.5% higher. There's Tata Consumer, there's the Shriram Finance, and it's the big boy itself. Reliance charging up the bulls this morning with a gain of about 1% thereabout. Even some of the tech names like HCL Tech, Tech Mahindra, all on the upside. So overall, it's looking good for the Nifty. The only stocks in the red, actually, Kotak Mahindra Bank, Reddy's is subdued after numbers. And Infosys seeing some profit taking. Remember, it was one of the biggest gainers last week.
Sorry, Infosys goes ex-dividend by 23 rupees.
Yeah.
So that explains the fall.
That explains the fall. But other than these 3-4 names, Kotak, Infosys and Reddy's, otherwise Nifty is looking good. 80 points higher.
Well, that's right. Let's focus on a few more names. Coforge, that's the stock of the morning, flying away up 5.5%. So that's the big result reaction from the broader markets. In the next 15 minutes, you'll have the management with us on the show. Vikran Engineering, that one won an order, so that stock is up close to 3.5%. SBI Life as well. Yash told us that those numbers look better than expected. The street was in position for it as well. So that's why that stock up and about in today's trading session. Saman Capital, well, that has moved into the F&O band. That stock is up close to 100%, but it's moving on large volumes. SAIL as well should come up for your screen because you have Tata Steel that's reacting to the upgrade. You have SAIL as well that's reacting a little bit positively, and SAIL as well has gone into the the F&O band. So that explains why that stock, in fact, is up and about. Cigniti is up close to around 6.5%. Remember, it's moving in step with Coforge. That's the new owner out there. They've been sounding quite positive on prospects as well in the integration. So 6.5% move on that particular name. All in all, a good start. Holding on to the start is going to be important. Last two trading sessions, we have come off 150 to 200 points from the high point of the day. So the bulls will like to sustain this big opening.
Well, Brigade Hotel Ventures, we were talking to the management earlier. They're talking about doubling their key count from 1,600 to 3,300 by FY30. That stock has opened out with a gain of nearly about 4%. eClerx too is reacting to a good set of numbers, plus there is that buyback, and eClerx has a positive start. We should pull up Latent View too. That also reacted to numbers. Numbers looked okay, but the stock, I think, is down close to about 2.5%. There is some news in Godrej Properties, so that's pushing the stock higher. NCC, more than 6,000 crore order win, 6,600 crore. NCC is gaining ground. On the way down, Bharat Rasayan has a 7% downtick. I think there is some board meet, bonus issue, etc. on Bharat Rasayan. And the other one is Zentech. Disappointing set of numbers. So Devyani points out the revenues are down 28% on a year-on-year basis. And the company says that Q2 performance was subdued because RFPs were delayed due to priority for Operation Sindoor emergency procurement. But the company goes on to say the long-term revenue visibility remains strong. But Q2 was weak with a decline of 28% in their top line. Other than that, you've got softness in some GK Energy. You've got Pace Digitech. This is also one of the recent listings. You've got SCI on the softer side. Ola Electric has given up some ground, but about 0.25% up on the Nifty and the Sensex. Not quite the roaring start that you had across the rest of Asia, but mid-cap's doing better, up half. On the
rest of Asia also has, so much of deal excitement going for it, right? Including some of those regional ASEAN markets at the end of the ASEAN summit. But nonetheless, I mean, the bulls are trying to hold their ground, 70 points higher. So it's not slipping, and that's good news. And that's what the market will hope for. Reliance is the big torchbearer, so to speak, along with big names like SBI and L&T. Some of these big boys are firm at the crease right now. So let's see. Decent start.
This Kotak Mahindra Bank, there is a JM Financial downgrade. And they say that given the 10% rally in the stock price in the last 1 month, the current standalone valuation is 2 times price to book. That's about a 10% discount to HDFC Bank and ICICI Bank. And therefore, based on the valuations, they are, downgrading the stock to a reduced. Target price stays at 2,100.
Okay, all right. Let's then discuss banks and more with our next guest. Our market master of the day is Dheeraj Agarwal, Managing Director at Ambit Investment Managers. Dheeraj, great to have you with us. Hope you had a fantastic Diwali, and greetings of the new Samvat to you and your team.
Thank you so much.
That's the real question, right? Like, in the absence, the moment this India-US trade deal comes through, we'll have a different conversation. But as of today, in the absence of that clarity, I mean, are earnings giving enough ammunition to the bulls to sustain above all-time highs and to decisively head higher from where we are?
Not at this moment, no. But the hope that the next quarter earnings will be significantly better is high, because the festival season demand has been pretty robust, triggered by festival season itself, obviously, and the GST cut impact flowing through. So I hope that the December quarter earnings are significantly better than what we have seen in the last few quarters. And that will be very, very essential, as you rightly said, to keep the market sustained at a much higher level.
So, Dheeraj, let's talk about financials, right? Because that's where the excitement really is, whether it's numbers, whether it's deals. It's all about financials now, finally. First, let's talk on just purely on P&L, what you've seen from large lenders so far, or even large NBFCs. Like most point out, the margin compression has been lower than anticipated. Now, Kotak could be an exception, and therefore Kotak's kind of lower today. But what is your read-through looking at Q2 earnings so far and the commentary?
I think if you see Q2 earnings so far, barring either a small margin beat or a small margin slip, which I think is too much of micro analyzing, results have been by and large in line. So there are no big positive surprises, there are no big negative surprises. And once again, going forward, I would link financials to the strong festival demand that we have seen in the month of October. Indian financials are a lot more linked or leveraged now to consumer demand as compared to capex demand, right? Because everybody is growing the consumer book much faster than the industrial book or the corporate book. And hence, if the consumer uptake that we have seen in the last 1 month sustains, I think credit growth also picks up at least by 200 basis points. And that will be good news for financials too. So to sum it up, I am positively inclined towards financials.
What percentage of your portfolio will you allocate to financials, NBFCs, the capital market plays?
Yes, NBFCs and financials for sure.
What percentage of your portfolio?
Yes, I will be overweight, meaningfully overweight.
Meaningfully overweight. So if, banks account for what, 35% of the Nifty? Approximately 31, 32%. So how high would you go?
That's a tricky one, but I personally am comfortable going up to 40, 42.
Oh, okay.
Yeah.
All right. Hi, Dheeraj. What about tech? How are you placed out there? You get the signals that are coming there, rather mixed. The next management as well, I request you to, tune into that conversation. We'll have Sudhir ji who will be talking about Coforge's numbers. And Coforge as well as Persistent have continued good growth. And that's why the street rewards them with good multiples. So how would you place yourself on tech, between the large cap, the smaller cap names, and what do you like?
So tech is a very, very bottom-up space at this point. So industry as a whole is struggling for growth. The industry as a whole, the growth is now at best mid-single digits, which doesn't make the outlook for the sector as a whole very exciting. Valuations haven't yet come down to, my benchmark is valuations have to come down to 2016-17 levels, and there's still another 20%, 25% low for the sector valuations to go to reach there. To say that even the current low growth is now fully discounted, and one can now buy as a bargain buys. So tech is, you can't even differentiate tech into large, mid, and small, and bucket it saying mid and small is doing better than large. There are few individual names, as you rightly pointed out, which are continuously outperforming in the earnings, and markets are rewarding them with much higher multiples. But overall tech, I would continue to be cautious till such time valuations guess 2016-17 levels. That's my broad benchmark.
Okay, that's IT. Dheeraj, what else? What else are you studying, observing? Maybe don't have a straight-out buy as yet in this market. There are a lot of the new age plays as well, or plays that are quasi-linked to new technologies now, whether that's EV or whether that's data centers. Anything that catches your fancy?
So one clear space, we started the discussion with strong consumption demand, but we didn't discuss the consumption sector. So consumer discretionary with an element of premiumization, that is one clear space which I think should stand out. And again, I'm qualifying this slightly by saying one hopes that the December quarter numbers are strong and this momentum continues at least for a few quarters more. There is also an expectation that the 8th pay commission, once it comes into play next year, sometime mid of next year, will also help consumption. So, but more positive on discretionary as compared to staples. Staples has its own challenges, and a little bit of price cut doesn't really move the demand needle for staples, but it does move for discretionary.
But discretionary, Dheeraj, allow me to ask you, because discretionary itself is a very wide umbrella. So, it could include alcobev companies, it could include jewelry companies, and so on and so forth. So, if you could kind of give us some more clues and hints, what part of consumer discretionary looks good to you?
So, I classify even automobiles, the personal use automobiles, not commercial vehicles, as discretionary consumption. So, that would be my number one bet, because automobiles, the price elasticity, the demand elasticity to price is reasonably high. And I would be surprised if demand growth does not pick up and sustain for a prolonged period of time. Once you go below that, then it's very, very individual stock specific. I think jewelry should do well generally as a basket now that the gold price is trying to settle down at a slightly lower level as compared to the recent peak. Typical consumer behavior is when the gold price is rushing, they sort of hold back on jewelry purchases. When it cools off a little bit and settles down, the jewelry purchases come back. So jewelry could be another sector. Consumer durables, white goods, brown goods, those would. So the segments which are typically price sensitive, air conditioner prices goes down by 10%. You say, chalo le lete hain. Bahut din se postpone kiya hai. Same thing for cars, etc. So higher ticket consumption and more premiumization consumption as compared to lower ticket. I think that should pretty much classify where my thinking is.
Dheeraj, any initial thoughts on Lenskart? There is a press conference scheduled today. We know it's a very popular brand across age categories. The company has grown very fast. As of FY25, the company's top line is 6,650 crore rupees. So it's grown fast. The only thing is, when you look at the valuations, I think it's going to come up, fairly steep. Trailing, it's more than 200 times. FY25 PE, I believe, is more than 200 times. Market cap will be 70,000 crore. Have you any initial thoughts on this? Not a buy or sell, but considering it's a consumer company and that's a space you're interested in.
So it's seeing a very, very strong growth, right? So typically, any company which has that kind of a growth, we always find markets struggling to figure out what the right pricing is. So I think it should get a good response. I think it should do a good listing as well. How far the listing gains actually sustain will depend upon can they sustainably deliver the growth in the next 2 or 3 years. But typically, very high growth companies tend to get rewarded with excessive valuations in the market. So I think Lenskart falls in that category. They've executed really well. So on the whole, on the IPO itself, I'm positively biased, but let's see long term.
All right, Dheeraj, a quick word on renewable energy. I think that was the theme that you said has a bigger runway. How do you approach it? Because there are various verticals, whether you're going for solar, the different other types of energy, maybe another way of looking at it. So tell us more about this theme that you like, renewable energy.
So as a percentage of total energy consumption, renewables will keep going up. There is a clear government thrust. There is a clear need with respect to pollution, environment, and climate. And every company involved, including NTPC, which has historically been a thermal energy company, has been investing a lot in the renewable space. So the entire ecosystem within the renewable space, whether it is battery storage systems, panel makers, the energy companies itself, etc., will see a very strong business environment for the next 10 or 15 years. To convert that into stock picks is, however, a little bit more challenging. So, for example, if BSS takes off, the TND investment required will be lesser than what we believe will happen at this point of time. So one needs to take cognizance of that. There are lots of new emerging technologies which can disrupt linear thinking that this will require more TND, hence just go ahead and buy TND companies at any valuations. And the third that one needs to take cognizance of is many of the companies which are leveraged to renewable energy space are already trading at pretty steep valuations. And one of my observations in the market at this point of time is markets have become valuation sensitive. We have seen quite a few stocks, despite good growth, but valuations being steeply high, actually not performing in this market.
Dheeraj, always a pleasure chatting with you. Thank you very much for joining in. But do listen in to the next conversation. We've got the management of Coforge joining us on the show. It's a very strong performance. Revenue growth came in at 5.9%. Margins expanded to 14%, as has been the company's guidance. And they're talking about a robust H2 as well. Sudhir Singh, CEO of Coforge, will now be joining in. And some of the things that we'd like to discuss with him is what's driving this confidence about the second half of the year, the outlook on margins after the company's achieved 14%, and what beyond the $2 billion revenue run rate that the company had put out, because now it's within sight now. Sudhir, thank you very much for joining in. This is Rima here. Tell us about H2 and how you see it. You sounded very confident in the call, but because Q3 is a seasonally weak quarter, but you expect a bounce back in Q4. I mean, what are we looking at?
I think you put it very aptly. Q3 is a seasonally weak quarter. We believe the entire year, given what we've already logged at the end of H1, which is almost 26+% growth, is going to be an extremely robust year. There will be the usual moderation that happens in Q3, and then we would expect things to normalize in Q4. We expect, on the whole, fiscal year 26 to be a robust growth year for the firm, as we'd indicated at the beginning of this year as well.
And on margins, now you're talking about 14% margins at an aggregate basis for FY26. Is that correct?
That's absolutely right. And we, incidentally, you would have noticed this, we've logged in 14% EBIT in quarter two itself, which was almost 250 bips higher year on year. Our outlook for the full year again is 14% EBIT, and it's our intent to make sure that we get there.
Okay. And what will be the impact on account of wage hikes in Q3 on your margins? And you also spoke about how that beyond 14%, you don't plan to expand margins. The priority will be on growth. So take us through that too.
Right. Quarter three, we've already declared annual increments for the entire workforce effective the 1st of October. That's going to be a headwind. There are also tailwinds on the margin front because the ESOP cost is going to fall materially in quarter three again, just as it did, and just as it fell in quarter two. So quarter three, with the wage hikes, which will be a headwind, with the tailwind put together, we'll try to make sure that we turn in numbers that across quarter three and quarter four land us at the 14% that we need to land at.
All right. Hi, Sudhir. Good morning. Good to see you, Ben. Quick question. 80 basis point margin expansion is what we saw in the last quarter. How much of it was because of the rupee depreciation?
There was an element of the rupee depreciation in play, but the one thing that I do want to call out about our results is we also take our hedge losses and gains to the top line. We had a headwind of 78 bips because the hedge losses this quarter were higher. So we had headwinds of 78 bips because on account of the hedge losses higher than quarter one. We had a tailwind of 20 bips because ESOP costs were lower. In total, our net headwind was 58 basis points. And after that headwind, we have reached the 14% EBIT that we did call out for quarter two.
Okay, all right. So that's encouraging to hear then. You're already going at a run rate of around $1.8 billion approximately. You were talking about around $2 billion, right, in FY27 at some point of time. Is there a possibility next couple of quarters you move to that $500 million a quarter run rate, which in turn means that you've got to the $2 billion run rate?
Well, we don't give a revenue guidance, but obviously, as you can imagine, the intent is to get to the $2 billion run rate at the earliest. We believe, within sniffing distance of that $500 million per quarter, which is the $2 billion annualized run rate. The intent is to keep the feet on the pedal and to keep and to get to that at the earliest possible.
Sudhir, hi, great to have you with us on the show. Again, investors pretty happy with the performance, and it's been so steady, right? I think another thing that the street is taking heart from is that this whole issue about the free cash flow and your investments and the whole confusion around the data center, that's a thing of the past. Correct me if I'm wrong, but the numbers that I have suggest that your free cash flow is back to about 37 million. So what is the guidance on the free cash flow and future investments, data center or otherwise? And just talk to us what this whole AI pivot will also mean, because I think you made a reference towards this even in the investor call. So tell us about some of this in the future investments.
Well, our free cash flow, you're right. Our free cash flow to PAT for the quarter was 86%. Our guidance on a go-forward basis is that it will be our intent to keep the free cash flow to PAT metric somewhere between 70 to 80% on an ongoing basis. As far as AI is concerned, we've always said this, and we continue to maintain this, that what has differentiated us and our performance over the last 4 years has been an execution intensity that is uniquely our own. We've always said this, execution is not just about sharing plans or strategies and sharing them in public. It's more about making sure that what you share actually gets done. There is no place which exemplifies this ability of Team Coforge to bring execution to life than in our ability to not just embrace AI in our internal operations, but also to be able to create our own IP, our own frameworks, which we have, which are the ones that are actually driving the transformation that we are seeing and the revenue uptick that we talk about. When you look at Coforge, Code Insight AI, which is our platform, is the platform that we're using for some of the largest reverse engineering pieces of work that we're doing with code right now. When you look at Forgex, we're using that platform, again, our platform to drive transformation at scale. And if you consider Blue Swan, which is our orchestration and automation AI-based platform, that again is driving it. So AI, for us, our ability to embrace it, our ability to bring it to life and not just talk about it.
No, absolutely. No, absolutely, Sudhir. And that is driving the kind of revenue momentum that we're seeing. But what I'm just trying to understand is that from an investment point of view, whether it's organic or inorganic, is there a specific AI/data center related additional investment that you see ahead on the horizon that you can call out?
Absolutely not. There's going to be no further AI data center related investment that the investors should expect. And we were very categorical about that in our investor call as well.
Sudhir, just to get back to the point about growth and margins. Now, you've said the focus will be on growth rather than pushing margins beyond 14%. But at what point will that change? Will it change when the company's top line hits $2 billion, as is the first goalpost? Or would you like it to, say, hit $3 billion before you will look to also simultaneously expand on margins? Because some of your peers are operating at higher margins.
Well, I wish to be very clear. We haven't said that the intent is not to move beyond 14%, but what we did say and what I did say at the beginning of this year was that our first goal for fiscal year 26 will be to hit an EBIT of 14%. We feel confident with that guidance at the current point in time because Q2 EBIT itself was 14%. Having said that, we believe that once the 14% EBIT baseline is secured, that's the minimum threshold by way of ambition that we will retain for us on the margin side. The primary imperative is going to be growth, if possible, industry-leading growth, as we clocked in FY25 and are likely to clock in FY26. EBIT will increase, but we aren't giving an EBIT increase guidance. As far as we are concerned, the pecking order is very clear. After we hit 14% EBIT, growth will be the primary imperative. EBIT, of course, given the operating scale-up that will happen, will continue to inch upwards.
All right, so the final couple of questions before we let you go. Why are the deal wins stuck at around $500 million? And now with Sabre fully ramped up, do you think there'll be a slowdown on deal wins? So you can give us some kind of color with regard to deal wins on a quarterly run rate. And also your interest cost, it's holding around 40 crores per quarter. I think your total debt in your books is around 650, 700 crores. Explain this to us because that's an annualized interest cost of around 160 crores. I'm guessing there'll be some stretched working capital there. Go ahead.
Sure. I think why only $500 million is somewhat uncharitable because we hit the $500 million benchmark very recently. If you go back 2 years, the firm used to clock an order intake on an average of $300 million. So over the last 2 years, that number has moved dramatically. 500 million is a number that we take a lot of pride in. The intent is to keep inching upwards, but at this point in time, if you look at the next 12 months signed order book of Coforge, that is 26.7% higher than where that signed order book was just a year back. So 500 million, the intent is to continue pushing it upwards. If you look at our large deals, even in Q2, we've signed 5 large deals. In the first half this year, we've signed 10 large deals, contrasted with 14 that we signed through all of last year. So our large deal velocity is going up. Large deal median size is going up. And I think it's a matter of time before the 500 becomes a 600 or a 700. But as always, we aren't giving a timeline or a forecast around that.
Okay. All right. And the interest cost, you just want to comment on that?
I wouldn't have the numbers handy with me, so I can't give you those numbers offhand.
Okay. All right. So, thanks a lot for joining in. Good quarter. Sounding optimistic about the future as well. We'll track you to a few of these numbers that you've given us. Wishing you a good day ahead and a good quarter ahead as well.
Thanks very much.
Well, a quick note then for our viewers. As you can see on the screen, what's going to come up for you, there's a money control stock score just above the line graph. This is a score assigned to each stock based on Money Control's multi-factor algorithm. It's calculated by analyzing over 40 parameters, including both the current and the historical financial statements, the price charts, the technical indicators for each stock. Now, each of the individual parameters is considered for calculation of these 4 factors. They're assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or a sell recommendation. Any investor, viewer is advised to carry out the necessary diligence on their own or through a certified registered financial advisor for investment decisions. So take note of that. Well, time to slip into a short break, but up next we have Shweta of Elara Securities who will be joining in to talk about her expectations from the NBFC sector. Stay with us. Well, as promised, it's time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, NBFCs are on our radar, and Gaurav joins us to tell us what do we expect from that space. Over to you, Gaurav.
Well, yes, when we look at NBFC space, let's see how are the quarterly updates and what's the landscape going ahead. So when we look at the quarterly updates, we have seen a quite mixed set so far. Retail focused NBFCs like Bajaj Finance and L&T Finance, they have reported healthy set of numbers on a year-on-year basis in terms of AUM growth. While on the other hand, M&M Finance, we saw a little bit of weakness. They reported around 13% growth in terms of the overall AUM. Now coming to the quarterly results expectations, when we head into second quarter, it is likely to be a tepid quarter for most of the NBFCs, but disbursement growth, that is expected to pick up, and this will be because of the asset quality front also. If you look at the challenges, they are likely to persist, but at the same time, we may see some kind of impact which will be offset by spread expansion. MSME and MFI, that is one thing that we should be watching out for, because here we may see some pressure to continue. But at the same time, when we look at the margins, they should get a lift, because this will be the first quarter where we will see the reflection of 100 basis point of repo rate cut completely. So that is something that we're expecting, that margins may actually increase. Now let's break it down in the segments. First, when we look at diversified financiers, now starting with this segment specifically, because we have seen already some of the updates coming up, and from here on it is likely to see that the disbursements, they are likely to pick up. Credit cost, that should stay steady, and at the same time, when we look at margins, we may see some kind of improvement in terms of margins. In fact, if we look at all these parameters, that is the reason why we've got some of the players who can expect profit to increase somewhere in the range of 12 to 30%. At the same time, when we look at credit costs, that is likely to remain contained, and that is the reason why ROAs, they are likely to remain stable for this quarter at least. When we move ahead to vehicle financiers, now AUM growth, that is likely to moderate, because if you look at Chola Investment, we have already seen they have cut down their growth guidance, and at the same time, if you look at the expectation now, Street is not expecting any kind of major growth above 20% specifically in this sector. But when we look at the profitability, now that is still likely to stay strong, and this is because of the margin expansion from fixed rate vehicle loans. When we look at credit costs, that is something that we should be watching out for, because some of the brokerages, they expect credit costs to increase. In fact, when we look at some of the updates in likes of Kotak Mahindra Bank or some of the NBFCs, HDB Financial, we have already seen they are talking about retail CV and specifically some stress in CV segment. Now, second half, that could be better. That was because of the GST cuts improving demand and at the same time volume uptick. But for now, ROAs are likely to remain range bound for second quarter. When we move to housing finance companies, in this segment specifically, disbursements that are likely to remain strong, specifically for the players like Aavas and Aptus. In fact, when we look at some of the expectations, we are expecting, brokerages are expecting Aadhar housing to remain a little bit of weak in terms of disbursements. But when we look at credit costs, that is likely to move down. We may see improvement in net interest margins as well. And at the same time, all these parameters, these will help these companies to expand their ROAs anywhere in the range of 0 to 20 basis point. Lastly, when we look at MFI segment, now this is something that we should be watching out for in terms of the asset quality, because in terms of disbursement, we are already expecting some kind of weakness here. And at the same time, when we look at credit costs, it is likely to remain higher. And at the same time, when we look at the return ratios as well, we may not see any kind of uptick here. But from here on, it is expected that this segment will reach its rock bottom, and that is the reason why we may see some kind of gradual pickup, and this will be because of the non-MFI diversification, new MFI guardrails that we have seen. We have already seen RBI also relaxing some of these guardrails, and at the same time, MFI cycle, which is expected to bottom out. All this can actually give a boost to the expectation going ahead. Now, when we look at gold financials, finally, we've already seen a huge rally in gold prices, and specifically when it comes to Muthoot Finance and Manappuram, we are expecting gold loans specifically to remain strong. In fact, for Manappuram, although the overall loan growth can be a little lower, but when it comes to gold segment, we may see this growing at around 20% even in FY26. When we look at some of the metrics, we may also see net interest margins to expand healthily for Muthoot and Manappuram both. And at the same time, when it comes to Muthoot, we are expecting to see around 25% ROE sustaining for FY26. And for Manappuram, profitability will also improve because of the provisioning in its MFI arm, which is coming down. So overall, when it comes to NBFCs, we are entering into a phase of selective resilience is what we can say, where we will be seeing a well-capitalized and secured lenders which are at a better place. And at the same time, growth is actually moderating, but at the same time, we will also see some kind of new upticks and new point of view in terms of the second half of FY26, which is expected to be better for NBFCs, not in terms of growth, but also in terms of margins.
Thank you, Gaurav, for joining in. We have with us Shweta Daptardar, Vice President, Diversified Financials at Elara Securities, joining in. Shweta, so just first big picture between the consumer retail financiers, the auto vehicle loan financiers, the gold financiers, and the housing. If you just break it up, or maybe we'll add the fifth one, MFI. If you break it up into these five, which is the segment you're most bullish on, where we will see growth and valuations are comfortable? And then we'll get to individual stocks and expectations.
Yeah, hi, good morning. Thank you for having me. So definitely gold financiers and mortgage lenders continue to dominate the overall credit growth and demand in the current scheme of things. Laggards is the biggest. Laggards have been still credit cards, where we have seen, although asset quality challenges receding, but moderation in or the softer trends in cards in force edition. However, having said that, we have seen certain green shoots now surfacing on the MFI and MSME credit. I mean, we would be certainly believing that second half looks very strong for MSME credit uptick. Also, personal loans pain cycle is fully behind. So we believe personal loans and MSME credit to sort of start looking up in second half of this fiscal. And largely the benefits are now flowing from the numerous tailwinds that we are seeing in the sector. So one is, of course, the domestic policy easing. I also believe another 25 bips rate cut is in offing before the calendar year end. So definitely the peak of consolidation or fiscal consolidation is behind. On net, the time is ripe for the credit demand to pick up. And I think that bodes really well for NBFCs. Not to forget, of course, the GST simplifications.
Yeah. So, Shweta, you called out two segments specifically, which you think will be really hot in the second half. You mentioned personal loans and MSME credit. So tell us the stocks as well, the NBFCs that are the best plays on this.
Yeah, so clearly two biggest tailwinds will be emerging in second half of the fiscal. We have seen bank rate card transmission now happening for the NBFCs, which is already in offing. Q2 numbers, whichever the companies have declared, we have seen interest cost materially coming down on sequential basis. So rate card benefits are flowing through. Juxtaposed to that, we have GST simplifications, which happened only at the fag end of the quarter. So those benefits will be fueling this consumption story. So definitely Bajaj Finance, L&T Finance, few of these smaller emerging mid-cap and smaller players in the MSME credit space should also start looking up. So yeah, net, it's a positive picture for the overall credit demand.
All right. Hi, Shweta. Good to hear your thoughts as always. On gold finances, tell us how do you approach the space? Because, there are three notable players, so to call it. The large one is Muthoot, but that's trading at, I think, 3 times. You could correct me on that one, price to book. You have Manappuram, which could be the turnaround story with the new management in place, but that's at less than 2 times, I think so. And IIFL Finance as well has an element out there. How do you play this theme? And are you still confident about the largest name, which is Muthoot, or do you have a neutral rating?
Yes, Nigel. So we continue to maintain a positive stance on Muthoot Finance, and largely it's emanating from the fact that geopolitical upheavals continue to keep gold price on the higher side. I mean, of course, knocking off the near term or the latest volatility. Having said that, as you rightly pointed out, Muthoot is already trading at 3x plus kind of valuations, FY27 price to book. What we are advising here to the clients is so Muthoot is clearly an accumulate on every dip or correction, if at all it's happening, because even as we move ahead next year, even if you factor in certain volatility in the underlying gold prices, Muthoot is poised to deliver 20% plus growth and 20% ROE. So that's pretty strong and pretty much justifiable as against the current expensive valuations. Coming to Manappuram and IIFL, yes, there is a turnaround story, both sort of surfacing for both of these names, but apparently that's been largely priced in. So Manappuram, particularly the new management, the strategy, the kitchen sinking, the execution will now determine the second leg of re-rating. For IIFL Finance, yes, the gold franchise is definitely picking up, but overall console ROEs, I think those are still not yet there to the desirable levels. So clearly Muthoot is a winner, and I think we will definitely see the stock rally sustaining for another 1 year or so.
Okay. All right. Shweta, thanks very much. Very helpful conversation. So it seems good times are rolling in for NBFCs as well as general demand for credit picks up. And of course, perhaps we have, slightly more generous RBI with a slightly looser policy in the coming months as well. Well, we're going to stay with the banking and financial services landscape. Like we pointed out, there's so much going on, so much of regulatory changes, including, of course, a whole host of new norms that were announced on Friday, draft regulations by the RBI. And let's not forget, Deal Street is buzzing. It's literally alive and kicking. And last week saw the culmination of another large transaction. Blackstone's picked up almost 10%, 9.9% stake in Federal Bank, marking another big investment in the financial sector, Indian financial sector. And this follows a string of deals. RBL Bank and Emirates NBD, then we have the Yes Bank deal, and even IDFC First, which managed to pick up private equity interest of late. So to decode what's fueling this excitement and this interest in Indian lenders, we have with us Amit Thawani, Managing Director and Head of Investment Banking at Nomura, India, and a veteran from the BFSI landscape, Mr. Rajneesh Kumar, former Chairman of State Bank of India. Gentlemen, thank you so much for joining in. Much needed perspective. Amit, if I could open with you, correct me if I'm wrong, I believe your team was involved in the deal. I know you won't get into deal specifics, but really, where is this interest coming in from? 6 months, 6 to 8 months, and a flurry of deals happening, and lots of equity capital pouring into Indian banks.
Surabhi, firstly, thank you for having me on the show. You're right. The last, call it this first half of the fiscal, has seen a flurry of transactions, not only in banks in general, on financial services space, both from private or strategic capital providers as well as capital markets. Let's not forget, I think we had discussed earlier in the year that you will see a flurry of deals on the capital markets, and actually that's happened. Large IPOs, large placements, etc. We are at the cusp where, when you look at from a growth perspective, hopefully the growth is kicking off quite fast now. You are at a stage where Reserve Bank of India has been very proactive and been nice to the industry in terms of bringing in norms which can help in terms of credit creation. And you're at a stage where the Indian banking sector, both from a technology perspective, both from a balance sheet perspective, is very well poised to capture this growth. And that's obviously attracted attention both of private equity capital providers as well as strategic capital providers. Although each deal has its own reason and own rationale for having, so there's no particular trend that you can identify, and they all happen to happen at the same time. But each deal has its own reason why it's happened. But the core of the matter is that you have a very strong economy, you have a very strong banking and financial sector, and that's, raring to grow.
Is it also that you have cheap valuations? Because some are already making that argument. I'll tell you, Sandeep Tandon of Quant Mutual Fund was on the channel last week, and they are large shareholders in RBL Bank. Again, not getting into specifics of a deal, but the argument of an existing shareholder in that case was that, look, you should have sold at a higher price. So what do you have to say about the prices at which these deals are being discussed and negotiated?
Well, the risk rewards looks in favor. Let me put it this way.
Okay. And are there more such deals in the pipeline? At the start of the year, you said we were at the cusp of foreign, investors or private equity getting into the Indian banking. 3 are done. But do you see more such deals?
As I said, each deal has a different rationale, but we're busy.
We're busy,
to say the least.
All right, let's get in Mr. Rajneesh Kumar as well, the former chairman of SBI, who joins us on the show. Hi, Mr. Kumar. Good morning. Good to see you, Ben. What are you making of this big infusion of money into a lot of these banks? How do you see things panning out? Right. It's not just positive for the banking names. It could be an industry tailwind as well. Please go ahead.
It is positive in the sense that it creates a reflection that the overseas investors, they have a positive outlook on the Indian banking sector and the Indian economy, and they see the growth opportunities. But we have to take a very balanced view. If you look at the market share of the foreign banks in India, it has declined. Actually, the kind of share they had before the economic reforms were ushered in the 90s, and the private sector banks came on the scene, it was public sector banks and some market share for the foreign banks. With the advent of private banks, the whole scenario changed and the market share minuscule. Many banks have left also the domestic market, like the latest example being of Citibank. So we should not go very gung-ho about it. But the fact of the matter is that there are certain banking institutions who are looking to have a foothold in Indian market. This could be their strategy to have presence in India. The most suitable segment in which these banks prefer is always wealth and personal banking, and wealth is growing in India. We know the middle class is growing, high net individuals are growing, and the wealth of a large section of Indian community is growing. So that makes it an attractive space. Competing in retail is always a tough task for any bank, whether it's even a large scale bank and operating in any jurisdiction, not to speak of India. So that is always a tough task. So to that extent, if these banks are taking a stake in a bank who have presence in retail, like we saw Yes Bank deal, RBL, earlier DBS acquired Lakshmi Vilas Bank. So it means that there are certain banking institutions who have Indian who have interest in Indian market. But it's definitely a positive indication when it comes to the BFSI sector in India and the Indian economy as a whole.
Absolutely, sir. And what's also very interesting that all these deals are happening without that critical aspect of voting rights, without that changing or without any chatter around it, at least that we've heard. And Amit, comment on this, that, what are you hearing? I mean, is that still a conversation that voting rights are capped at 26%? Should we still get in? Because people have come in irrespective. So do you see this as maybe a build-up to again lobbying for some change there?
It's been going on for 25 years. And, RBI in its own wisdom will be very calibrated, and it is a sensitive matter. I don't think we should read too much into the strategic deals happening, being a build-up into changes on the regulatory front. The regulator, in its sharpest wisdom, will do the right things for the country. It is sensitive, as one would expect. I don't think we should read too much into what's happened, resulting in any regulatory changes as a sector.
Okay. There's also a lot of interest from Japanese players, right? I mean, actually interest from Middle Eastern players like Emirates we've seen. Then there is, there's names doing the round, Mitsubishi, UFJ. With the S Bank already we've seen Sumitomo, come through. Any particular color or take in terms of where all this foreign money is coming from and why?
So, Japan corridor or Asia corridor has been active. In the past also you see SMFG buying Fullerton. That was a couple of $1 billion transactions, so pretty large. You've seen Korean players taking a minority stake in Credila. So the Asian corridor has been active, and I'd say will remain active. They have been players who have been in India for a long period of time. A lot of them have operations in some form and shape. So are now comfortable with the lay of the land. And you will see strategic inbound coming in from Asia. DBS itself did a large acquisition. And the Middle Eastern corridor is a great one to look at because India and Middle East share a lot of commonality in terms of business, in terms of capital flows, in terms of culture, and can be a natural partner into India. So it's a great trend to watch out into.
Do you think it's an opportune time now, Government of India, to go ahead and divest IDBI Bank? We've been hearing about this forever. I've just reading a note that's coming from Macquarie. From a stock market perspective, they hope Kotak Mahindra Bank doesn't do it. They believe it's a de-rating event. That argument for another day. But do you think it's made government's job easier? It's an opportune time to go ahead and divest a bank that they've been talking about for the last 2-3 years.
It's a very strategic divestment. Let's not oversimplify it. It's a large bank.
Yeah.
And the government is doing the right things in terms of engaging with strategic players very deeply. Timing is a question of appetite in the market, which it is there.
Question for Mr. Rajneesh Kumar. Sir, while we take your point completely that the lay of the land when it comes to personal banking here in India, retail banking, is not easy. But would it be fair to say that perhaps for Tier 2 or Tier 3 PSU banks or even Tier 2, Tier 3 private sector banks, the competitive intensity is going to heat up because you have all this foreign capital coming in. And look at the Federal Bank press release. I mean, it goes on to categorically say that their ambition is to become the 5th largest bank in India. So what will change in terms of just the day-to-day operations over the next couple of months and quarters with this heightened foreign interest?
When there is a competition market, you and I should smile because more competition means more benefit to the consumer.
Sure.
And again, I'm repeating the same point that if the banking reforms were not carried out in 90s and private sector banks would have come in, there would have been no competition and then there would have been no desire to improve the consumer experience or these services. So competition is good and we have a very good regulatory environment in the country. So I think as a consumer, we all will benefit.
But what does it mean? I mean, will it mean, sir, perhaps the need to raise capital? Again, I'm talking about Tier 2, Tier 3 banks, PSUs, as well as private. Will they have to shore up their capital buffers? There's going to be fight for market share. So what does it mean in terms of business?
So it is all about the business strategy of a particular bank and the capital management. An efficient management of the capital, that itself requires a lot of attention from the board and the management. Capital is available, but is available only when that capital provider believes that you will be able to generate the returns commensurate to the expectation of the capital provider. In case of the government ownership, that is not as prominent because the public sector banks, they are to do certain businesses where it's not always driven by the commercial interest or the profit. So there is a different set of banks. You have public sector banks, they have the obligation to generate a decent return and perform well. But at the same time, they have obligations which are not necessarily very profitable, but they are bound to do it. It is their mandate. It is the desire of the government who owns the majority. The private capital or the private banks, it will always be returned to the shareholders. And in that sense, it's not a level playing field fully. Third is foreign capital or the foreign-owned banks, and their business strategy and the return on capital expectations are different. So we have three different set of people, three different targets or business strategies and the market segment in which they operate. Foreign banks will mostly operate in wholesale.
Okay. I think we just lost that line with Mr. Kumar. But he was saying that, strategies will evolve and it's large markets. Perhaps there'll be segmentation in any case. Amit, thank you so much. Very helpful conversation. And we heard you. You're saying it's continuing to be busy. It'll probably be busy and there are more to come. So we'll watch out for that. Thanks for joining us today.
Thank you very much.
Program.
Thank you.
Okay, we take a very quick break. Come back with an update on the commodity markets in just a bit.
Welcome back. Let's talk commodities now. Manisha is joining in, and it's copper on her mind right now. Manisha.
Thank you for that, Rima. Well, it is because that is the reason copper is trading at an all-time highs, near all-time highs right now. If you look at the copper prices, we've gained up by nearly 25% in this year till time. The all-time high that copper has seen on LME has been in May 2024 at the tune of $11,104 a ton. Currently, we are trading at around 11,000. It seems to be really gyrating around those levels. But the point being that we've seen 11,060 in the markets on Friday. So that tells you that we're not too far away from its all-time highs. And as I said, copper has gained up by nearly 25% in this year until time. Well, there have been various supportive factors to begin with. It has been about the decline in US dollar index in sense of macros. And then the US and China meeting this week could result in a trade breakthrough. All the statements that we've been hearing over the weekend have been quite supportive. You have threat of 100% US tariff on China now off the table, as Secretary Bessent has said. And then Beijing also is expected to pause for a year its rare earth export control. So both sides seem to be working towards something. Remember, they are the largest consumer countries, and China, of course, is important in sense of producer and consumption as well. But apart from that, it is about mining concerns, which seems to be keeping copper on the higher side. To begin with, it's about Codelco's El Teniente mine in Chile, which has seen some disruptions coming in. It also has to do with major sites in Dominican Republic, which have seen some electrical issues, and that is the reason the mines there as well have seen some shutdowns. Democratic Republic of Congo also is looking at some mining concerns there. And then you have the Grasberg mine in Indonesia, the accident therein, and we haven't seen much of that still come on form. The expectations are that the Freeport mine could be looking at all of its production coming in only by the mid-2026 or even 27 for that matter. That is what is keeping the copper prices higher. As you can see on MCX as well, we're looking at 1,000 rupees a kg right now. So very, very strong gains coming in for this one. There also is a report from BHP which says that there is going to be a lot of decline that you're looking at in sense of global demand by 2050, and that would be driven by energy transition. Also, the markets will watch out for the central bank meetings this week. You have US Fed meeting where expectation of a 25 basis point of a rate cut pretty much has been factored in by the markets. And then you have European Central Bank and Bank of Japan monetary policy meetings also this week. So lots of event and data coming in. But the street does believe that by the time we close this year, you could be looking at 11,001 taken off. So that means new higher highs coming in for copper pretty soon.
Thank you very much for that. Get into a break. On the other side is our special segment, Indonomics. Lata speaks to veteran bankers. Zareen Daruwala, former MD Standard Chartered, and Srini Varadarajan on RBI allowing banks to do acquisition finance and on the new foreign banks' interest to buy shares of Indian banks.